Jai Hind friends. Every month when your salary gets credited, it feels like progress. For a moment, there is a sense of control and security. But within days, that money starts disappearing. Expenses come in, payments go out, and by the end of the month, very little remains. This raises a simple but powerful question. Where does your money actually go? To understand this, we need to look at the financial system as a flow rather than a storage. Money does not sit idle. It constantly moves through different parts of the economy. The journey begins even before your salary reaches you. A portion of your income is deducted as tax, commonly known as TDS, tax deducted at source. This means the government takes its share first. That money is then used for public services like infrastructure, healthcare, and administration. So, from the very beginning, your income is already part of a larger system. The remaining amount enters your bank account. Most people assume their money simply stays there, waiting to be used. In reality, banks do not just store money, they use it through a system called fractional reserve banking. Banks keep only a small percentage as reserve and lend the rest to others. Your deposited money may be used to fund someone else's home loan, business expansion, or personal expenses. In this way, your money starts working within the system, even if you are unaware of it. At the same time, you begin spending rent, groceries, bills, and daily expenses. Push money back into the economy. Business receive this money, pay salaries, invest in growth, and the cycle continues. This is how economic activity is sustained through continuous circulation. One of the biggest outflows for many individuals is loan repayment. EMIs for homes, cars, or credit cards take up a significant portion of income. These payments go back to banks along with interest, forming a major source of their earnings. Over time, the total amount repaid can be much higher than the original loan, showing how borrowing impacts long term financial flow. Digital payments, especially through UPI, have further accelerated this movement of money. Transactions happen instantly, making the system faster and more connected. While these services appear free to users, they operate within a larger ecosystem where companies benefit through transaction networks and data insights. Even small payments contribute to this expanding financial structure. Above all these layers sits the central authority, the Reserve Bank of India (RBI). It regulates banks, controls interest rates, and manages money supply in the economy. When the RBI changes policies, it directly affects borrowing costs, inflation, and overall financial stability. In simple terms, it ensures that the entire system functions smoothly. Another important part of the system is investment. When individuals invest money in mutual funds or stocks, that money flows into businesses. Companies use these funds to expand operations, create jobs, and generate profits. As businesses grow, investors benefit through returns. This is the positive side of the financial system, where money not only moves but also grows. So, when you look at your salary, it does not remain in one place. A part goes to the government as tax, a part is used by banks for lending, a part is spent in the economy, a part goes toward loan repayment, and a part, if invested, can grow over time. Money is always in motion. Understanding this flow changes the way you see your finances. Instead of wondering where your money went, you begin to see how it moves and how you can control it. Managing expenses, limiting debt, and investing wisely are not just personal choices. They are ways to position yourself better within the system. In the end, the financial system is not something separate from you. You are already a part of it. The key difference is whether you understand how it works or not. Because once you do, you are no longer just earning and spending. You are making informed decisions. And that is where real financial control begins.